Hello, my name is Colin Crosby, and I'd like to welcome you to the 2013 Birken Road Video Report on Hornbeck Offshore Services. Hornbeck trades on the New York Stock Exchange under the ticker HOS. Through extensive industry and company-specific analysis, me and my analyst team, including Taylor Ashey, C.C. He, Philip Stewart, and Aki Wu, arrived at a 12-month target price of $47 and a market perform investment rating. Hornbeck Offshore Services is headquartered in Covington, Louisiana. The company is an industry leader in providing technically advanced offshore vessels to the offshore oil and gas industry. The company was founded in 1997 by its current president and CEO, Todd Hornbeck. The company completed an initial public offering in March of 2004 with a market capitalization of $267 million and has grown to a market cap of approximately $1.44 billion today. The company divides its operations into two primary segments, upstream and downstream. The upstream segment represents a large fleet of vessels which serve the deepwater and ultra-deepwater segments of the oil and gas exploration and production industry. Hornbeck's vessels provide an array of services that complement offshore operations such as drilling, construction, and rig maintenance. The upstream segment represented 97% of the company's 2012 operating income, while the downstream segment made up the remaining 3%. Hornbeck operates in 9 geographic markets and offers 6 service lines. The majority of Hornbeck's upstream operations are focused in the Gulf of Mexico and Latin America. In addition, more than 3/4 of the company's business comes from oilfield services. The rest of operations are focused on petroleum transportation and servicing the U.S. military. These tables show Hornbeck's competitive landscape in its 3 core markets. Hornbeck has a 24% market share in the Gulf of Mexico, a 3% market share in Brazil, and a 14% market share in Mexico. The company's largest competitor is a private company, Edison Schwest, which leads the Gulf of Mexico with a 30% market share. Hornbeck Offshore has both the highest price-to-earnings ratio and the highest price-to-book ratio among its peers, indicating the market is paying top dollar for the company's future profits. Hornbeck's return on equity is 4%, which is on line with the peer average. Other metrics, including enterprise value to EBITDA and debt to assets, are consistent with the peer average. Hornbeck has around 35 million shares outstanding, and approximately 90% are held by institutional investors. Most of the largest shareholders either maintain or increased their ownership during 2012. Bruce Hunt, who serves in the company's board of directors, is the only individual investor in the top 10 of shareholders. Taking a look at Hornbeck's stock performance over the last 5 years, we can see a big decline in share price from the end of 2008 to the early 2009, around the time when the financial crisis negatively impacted the global economy. There was another decline in share price in 2010 after the BP Macondo disaster. Hornbeck's stock price fell significantly because the Macondo disaster lowered investors' confidence in the whole industry. As the offshore oil and gas industry steadily recovered from the disaster in 2010, Hornbeck's stock has experienced a steady increase. The industry is dependent on oil and gas prices and offshore drilling activity. Currently, the industry is recovering from Macondo. Government regulation in the Gulf of Mexico has emphasized safety and the environment. In addition, customer preferences have shifted. Younger vessels with increased capacity, enhanced safety features, and greater flexibility are in higher demand. The upstream sector of the offshore marine service industry is exposed to certain risks. Low oil prices, natural disasters, government regulation, and a shortage of skilled crews will all impact the industry in different ways. The downstream sector is focused on transportation of crude oil and refined products. It may be affected by seasonal weather patterns and overall economic weakness. However, as we mentioned before, the recovery in the Gulf of Mexico has brought opportunities for the industry. Companies will strive to take advantage of large discoveries in the deepwater and ultra-deepwater markets, rising day rates, and growing international exportation and production activity.
This figure depicts historical and forecasted worldwide deepwater capital expenditures. Deepwater CapEx remained relatively constant from 2006 to 2010, but has steadily increased from 2010 to the present. This trend should continue going forward. And as this bodes well for companies like Hornbeck who offer the services necessary to support these deepwater capital expenditures. In November of 2011, Hornbeck Offshore announced its fifth generation OSV new build program. The initial order was for 16 300 level offshore supply vessels. The program was increased again in September 2012 and more recently in February of 2013. The current program calls for 24 total vessels. This includes 22 offshore supply vessels and 2 multi-purpose supply vessels. The program also has shipyard options on 40 additional vessels. Hornbeck has entered into this new build program in order to take advantage of the improving conditions in the deepwater Gulf of Mexico drilling industry. Worldwide, deepwater drilling CapEx is forecasted to double over the next 3 years. The increase in CapEx is very important to Hornbeck because deepwater drilling projects can sometimes require 2 to 3 OSV or MPSV vessels in order to support their drilling operations. The current cost of the fifth generation new build program is $1.16 billion. Hornbeck is financing this through operating cash flow, previously announced debt issuances, and its currently undrawn revolving credit facility. On March 1st, 2013, our team of analysts visited Hornbeck's corporate headquarters in Covington, Louisiana, with our investment research manager, Sal Rahman. We met with Hornbeck's CFO, James Harp Jr., Director of Corporate Finance, Potter Adams, and the rest of the corporate finance team. During our meeting, Mr. Harp briefly talked about the company's history and its recent earnings report, and discussed Hornbeck's upstream operations and its capabilities in detail. Mr. Harp and the rest of the corporate finance team are very optimistic about the recovery of the industry and how Hornbeck is positioning itself in the market environment. We utilize 2 approaches to value the common equity of Hornbeck: relative valuation and a discounted cash flow model. 4 peer companies were used in our relative valuation: Gulfmark Offshore, Tidewater, Secor, and Bourbon. The price to earnings ratio resulted in a value of $43.49 per share. The price to cash flow ratio resulted in a value of $45.08 per share. The enterprise value to EBITDA ratio resulted in a value of $43.49 per share. And finally, our discounted cash flow model resulted in a value of $44.83. We equally weighted all 4 methods, which resulted in a final value of $47. Our investment thesis on Hornbeck is based on industry and company-specific trends. On a company-specific basis, we believe that the 5th generation OSV new build program will allow the company to capitalize on increasing demand in its core markets. Offshore drilling has steadily been increasing, and there has been a flight to quality for offshore vessels, especially in the light of the BP Macondo disaster. Hornbeck's new generation vessels should be able to serve this need well. Increasing drilling activity in the deepwater Gulf of Mexico has resulted in increasing day rates, and these high day rates are pushing Hornbeck's revenues to new highs. Internationally, we believe that Hornbeck is in good position to continue to capitalize on increased demand. In Mexico, newly elected President Enrique Peña Nieto has announced an initiative to expand the operations of Mexico's national oil company, Pemex. In Brazil, the national oil company Petrobras has recently announced an aggressive budget allocated to offshore drilling. Finally, the company's downstream segment, although representing only a small percentage of operating income, has seen a rise in day rates and margins and should provide nice stability for the company moving forward. The Birkenroad reports are published solely as part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investments. Thank you for viewing our video report on Hornbeck Offshore Services. If you would like to view a written version of our report, it is available at www.birkenroad.org.